question will walk through the accounting for a defined contribution pension plan. Adventure Limited provides a defined contribution pension plan for its employees. Currently, the company has 40 full-time and 55 part-time employees. The pension plan requires the company to make an annual contribution of $2,000 per full-time employee and $1,000 per part-time employee, regardless of their annual salary. In addition, employees can match the employer's contribution in any given year. At the beginning of the year, 10 full-time and 15 part-time employees elected to contribute to their pension plan by matching the company's contribution. An equal amount of funds was withheld from the employees' checks in order to fund their pension contribution. Both employees' and employers' contributions are sent to the pension plan trustee at year-end. The first thing we're asked is, what amount of annual pension expense will the company report? Okay, so we know we've got $2,000 times the full-time employee, got 40. So we've got $2,000 times 40 full-time. Okay, and then we've got 55 part-time times 1,000. So 1,000 times 55 part-time. So that is going to give us, the total of those two. So this is going to give us 55,000. And this is going to give us 80,000. So the sum of these two is going to equal 135,000. So that is their pension expense for the year. Pension expense will be $135,000. So it's important to note that when the company withholds contributions from employees to match the employer's contribution, that doesn't impact the pension expense. That's going to impact the amount on the statement of financial position because the company has a liability to remit the amount, but the expense is simply the employer's obligation under the plan. Okay, next is prepare a summary journal entry to record Adventure Limited's payment to the plan trustee. Assume no accruals have been recorded for the employer portion and use the account pension contributions payable. So pension contributions payable is going to reflect the employer contribution, which is this 135, and the amount that they've withheld from the employees to match their contribution. It's not an expense for them, but they do have a liability to remit it because they've withheld it from the employees' paychecks. So let's calculate the employee contribution. So it's going to be, it says that 10 full-time and 15 part-time employees matched. So we're going to have 10 full-time, so 2,000 times 10 full-time, which is going to give us 20,000. And we're going to have 1,000 times, how many was it for part-time? 15 part-time, which is going to give us 15,000. So the sum of this is going to give us an employee contribution of $35,000. So the journal entry that the company would make is going to be debit pension expense, which is what we had already calculated above. So the employer's expense is the 135,000. They're going to have debit pension contributions payable. Because we're assuming that this amount would have been in a pension contributions payable amount. Now we're reflecting the payment to the trustee, so we're clearing it out. We've skipped the entry where we actually recorded this in pension contributions payable. And credit cash. So they have the cash from the employees because they've withheld it from their paychecks. So the total cash that they're going to remit when they remit it to the pension trustee is the sum of the employer contributions, which is the company's expense. This amount they've simply withheld from employees' paychecks. So they would have had this on their statement of financial position in a liability account, pension contributions payable, which now they're clearing out when they pay it, and they're going to decrease their cash by 170,000. And that concludes this question.